So, right now, in late March 2026, the crypto market is in a really weird spot. I mean, on one hand, you've got a ton of fear, but on the other, the industry just got maybe the best news it's ever had. It's a total tug of war. So, what's really driving the price?
Okay, so take a look at this. On March 20th, the Crypto Fear and Greed Index, it was sitting at just 25. And to give you some context, that is deep in fear territory. This is the kind of reading you expect to see when the market is crashing and burning, not when things are supposed to be great.
And that really gets to the heart of what we're talking about today. Because, get this, just a few days before all this fear crept in, US regulators handed down this absolutely game-changing decision. So, what's the deal? Why is there this huge gap between incredible news and, well, everyone feeling so negative? All right, to figure this out, we've got to start with the first major force in this tug of war, and that's a huge headwind pushing against the market, the macroeconomic pressure coming directly from the US Federal Reserve. So here's the breakdown from the Fed's big meeting on March 18th. And spoiler alert, the vibe was definitely bearish for crypto. They kicked things off with what's called a hawkish hold, which basically means they're keeping interest rates high. Then you've got the dot plot. That's where the Fed officials kind of show their homework on future rates, and it's now pointing to only one rate cut for the entire year. And check this out, this is pretty wild. 7 out of the 19 officials think we're not getting any cuts at all. 0. When the Fed talks like this, it's a massive signal for markets to dial back the risk. So, you might be asking, why is the Fed being so, well, hawkish? This chart pretty much tells the whole story. It's their own inflation forecast. See, for months, they were projecting 2.6% inflation for 2026. But in March, they had to bump that number up. Now, I know it doesn't look like a huge jump, but for the Fed, it's a big red flag. It means inflation is stickier than they'd like, and that means they've got to keep things tight. And Fed Chair Jerome Powell, he didn't beat around the bush. In the press conference, he pointed directly at the risks coming from oil prices and what's happening geopolitically in the Middle East. The message couldn't have been clearer. Don't even think about rate cuts until we see the official inflation numbers really start to cool off. And of course, the market reacted instantly. That hawkish tone from the Fed triggered a classic sell the news event for Bitcoin, and we saw a pretty sharp drop. And believe it or not, this isn't a one-off. It's a pattern we've seen after 8 of the last 9 of these meetings. Meanwhile, the US dollar got stronger and oil prices stayed high. That's textbook risk-off behavior, which is usually bad news for assets like crypto. Okay, but that's just one side of the coin. Because while the Fed was stirring up this headwind, something else was happening. An absolutely massive tailwind, all thanks to a game-changing regulatory move in the US. All right, to really get why this is such a huge deal, we need a quick primer. In the United States, financial stuff is usually put into one of 2 buckets. It's either a security or it's a commodity. Securities are things like stocks, and they're regulated super heavily by the SEC. Commodities, on the other hand, are things like gold or oil, basic goods, and they fall under a different, more open regulator, the CFTC. And for crypto, man, this distinction is everything. So on March 17th, and get this, it was just one day before that downer of a Fed meeting, the SEC and the CFTC put out a joint ruling that was, and I'm not exaggerating here, absolutely historic. They came out and officially declared a whole bunch of major crypto assets to be digital commodities. This might be the single biggest piece of regulatory news crypto has ever gotten. And we're not talking about a minor thing here. The scope of this is massive. It's not just Bitcoin. We're talking Ethereum, XRP, Solana, plus a dozen other big-name tokens. This wasn't some tiny tweak. It was like a tidal wave of legal clarity just washed over a huge chunk of the market. So what's the bottom line here? It's simple. This ruling just bulldozed a massive legal roadblock that was keeping the big, conservative money on the sidelines. For the very first time, we're talking about pension funds, 401ks, big corporate treasuries. They now have a clear path, a green light to invest in these assets, just like they would with gold or oil. So, there you have it. A powerful short-term headwind from the Fed and a monumental long-term tailwind from regulators. So where does this clash happen? Where's the battleground? Well, it's right there on the price charts. And right now, this fight is happening at a really critical technical level. You can think of it like a line in the sand on the charts. It's a price floor, a support level, or buyers and sellers are just duking it out, fighting for control. And if you look at this table, you can see how this fight is playing out for the big names.
Bitcoin, for example, is testing its key support right around that $68,800 mark. Ethereum's in a slightly tougher spot, actually trading just a bit below its support. But the one that really stands out is Solana. It's holding a really strong base above its support, which is why a lot of analysts are pointing to it as having the best-looking setup of the bunch.
And hey, it's not just retail traders holding the line here. The big fish, the major institutions, they're buying at these levels. Take Strategy Inc., for example. They're the biggest corporate holder of Bitcoin out there, and they just confirmed another huge buy. Their conviction is just off the charts. Their total stash is now worth a staggering $57.6 billion. That tells you they really believe this price floor is going to hold.
Okay, so the battle lines are drawn. Let's shift gears and look forward. What if the bulls actually win this thing? What if some of the historical models tell us could be next for the market in the long run? Well, a lot of analysts use this pretty common data-driven model. It's basically a three-step process. First, you project out Bitcoin's long-term baseline price. Then, you try to estimate how high, how frothy the market could get. And finally, you put them together to get a theoretical peak for this cycle.
Okay, step one. We project Bitcoin's historical baseline. For this, we use a key metric called the 200-week moving average. And based on its current trajectory, models are projecting that this baseline will hit right around $70,000 by mid-2026. Step two involves something called the Mayer multiple. It's actually pretty simple. It just measures how far the price stretches above that baseline we just talked about. Now, in previous cycles, this multiple got way, way higher. But as the market gets bigger and more mature, the peaks tend to get a little less extreme. So for this cycle, the trend is pointing towards a potential peak multiple of about 3.2 times.
All right, now for the fun part. We just do some simple math. You take that projected baseline of $70,000, you multiply it by that peak multiple of 3.2, and that gives you a theoretical price target for this cycle right around $220,000. Now, obviously, this is just a model, no guarantees, right? But it gives us a data-driven way to think about the long-term potential here.
And that really brings us full circle. This slide, right here, just sums up the whole conflict perfectly. In one corner, you've got the short-term pain, the hawkish Fed, expensive oil, a strong dollar. And in the other corner, you have the potential for long-term gain, that landmark regulation, huge institutional buys, and all that money still flowing into the new ETFs. So what we have here is a classic showdown. It's short-term macro fear versus long-term structural adoption. The market is sitting right on this critical floor, which leaves us with the billion-dollar question. Which side is going to win this tug of war?